All right, good morning, everybody. Hope everybody had a good Easter. So, looking at the news over the weekend, nothing really stands out. There was some negative news on Tesla, and of course, that thing is big enough to drive the market down. So, that could have a lasting impact this morning. Go to Market Watch. You can see there's not very much on the agenda today. 10 a.m. we have the housing market index, and at 11:30 we have additional auctions. It's really important to pay attention to those additional auctions. It is a place in time where we've seen markets go from being just completely range bound days to an afternoon trend. And it often happens right at the reporting time period. These additional auctions, sometimes they're at 11, 11:30, 1 o'clock. So today, especially on a Monday, really watch the clock as we come into 11:30. When there's not an auction, we generally look at the lunch period as like a consolidation period, a quiet period where the market kind of reassesses the news from the morning's events and then looks forward to the afternoon. So we often see, tight consolidation, clear ranges. But on a day like this, when there's additional auctions, that goes out the window. On Mondays, if you subscribe to the theory that the market has all news priced in and that price discounts everything, then on Monday morning, when the market is trying to absorb 2 days of news and price it in, take an additional day since it was a holiday, and look at today's Monday as an opportunity to really stay range bound through the morning, or to see um, a lot of extremes, moves to the upside with quick reversals or moves to the downside with quick reversals, as the market has to price in all of that news. On a typical Monday, it could take a half hour, 45 minutes. On a day like this, 3 days of a holiday weekend, it could take even longer than that to price in the news from the weekend. So we want to start with the daily chart on the S&P. Just kind of come out to the higher time frame. Take a look at the size of the implied volatility expected move. 4473 to 4300. This is a full week measurement. And if we set it on to last week's, we can see that it is very similar, almost identical. Last week was only a 4-day week. Take one more week beyond that, set it back a week even farther than that. And you can see that for the last couple of weeks, the implied volatility within the S&P has been really minimized. It's not very, it's not changing significantly. And this is really important to understand for anybody who's still watching the VIX on a day-to-day basis. The VIX is not responding the way we would normally expect it to respond. It's like everybody's become numb to these risks and moves that we're seeing. Even big sweeping moves in the markets are still really not causing that VIX to move the way that it normally would. This is one of the reasons we've been watching the dollar more closely. It's not a perfect proxy. And one thing that you could do, although, if we're making the argument that implied volatility is kind of muted or shunted, then this recommendation may not perfectly fit. But one thing that you could do is look at the VIX 9. So you just type in VIX 9D for 9-day. And this will give you like a really fast moving average of VIX, right? Obviously, it's candles, it's not a moving average, but think of it like a moving average. So if the VIX is a 3-month average, then you could consider the 9-day, right, a significantly shorter mathematical formula. And the VIX, all of the VIXs that we've been talking about, they're all nothing more than a math formula, right? It is not a real thing. VIX futures are a thing, but the VIX are nothing more than SPX options volume, really, trading volume, trading activity in the SPX 30 days out. So this would be a much more responsive VIX 9D. Not all brokers are going to offer that, however. So if you don't have a broker that offers that, I believe you can get it on Yahoo or maybe on Google. The main takeaway is that that volatility tool is directly connected to the expected move, because the expected move is a mathematical formula. It's a square root of time, but it does use the out of the money options aggregate to get that average that you see here on the right side of the options chain. Now, that number on the right side of the options chain that you see, most brokers will offer this. It's proprietary, and they don't share exactly how they get that number, but we know some of how they get that number. It uses all of the out of the money options on the call and the put side, aggregates all of them together, and gets the average. Well, if volatility is off, if it's not responding the way that volatility typically responds, then those expected move calculations are also off. Just the idea that in the last 3 weeks, when we were using that box and demonstrating that the size of the box has not changed significantly from the run up to the run down, they've been pretty much the same again and again and again. It's not responding, right? It's staying muted or shunted. So approach with caution. The cyan line that you see on this chart is a year-to-date anchored VWAP. So it starts at the first trading day of the year and goes to the present. We breached that yet again on Friday. So we're back below the yearly average. It's one way you could look at it, right? If VWAP is considered the average price and we are underneath it, maybe it's on sale. Heard somebody talking over the weekend about where the analysts are saying the market could be at the end of the year. You could go and look at what the analysts are saying, or you could look at where the money is going, right? Put your money where your mouth is, kind of thing. So what you're looking at here is the S&P futures, and on the right is November of 2024. Here in the middle is November of 2023, and closer to the left side is November of 2022. Right now we're sitting 43.77-ish. By July of 2023, we're looking at 44.70. ballpark area. And by November of next year, 4250. This is plotting the difference in these futures contracts. It's looking at the SEP and DEC Mar June contracts. It's going farther out and just plotting those numbers on the chart. This is showing that we're in backwardation. The front is higher than the back. That's not the way things with time price continuing normally look. Normally in a normal market called contango, we would start at the lower left and move to the upper right because things farther out in time, generally speaking, would cost more. Also, generally speaking, things farther out in time have more risk attached to them. There could be famine, war, drought, acts of God, destroy crops, knock a company out. There's so many unknowns in the future that, generally speaking, things in the future are higher priced. When they're not, when we're not in contango, when we're in backwardation. The ES futures market is in backwardation. I think it's worth taking a look at where we've been since around mid-January. And it was really interesting to note that while everybody is looking down and saying that this market is going to go down, I want you guys to keep in mind, generally speaking, the population at large is generally wrong, right? When everybody's looking down, you need to look up. And when everybody's looking up, you need to look down, right? The old phrase, buy while there's blood in the streets. So, I'm not saying that this is a head fake and that we should, go out and buy Apple and Microsoft and just go buy a bunch of tech. I'm not necessarily saying that. But generally speaking, the crowd is wrong most of the time, right? Of course, on accident, they got to get it right once in a while. Even a broken clock is right twice a day. But on the whole, overall, in general, when Bloomberg and CNBC and the talking heads are saying you should be buying, you should be selling. And if they say that everything is really nasty and that there's no way that this is going to survive without an economic downturn and there's going to be a crash and a recession and no, we should all just go out and sell everything, they're probably wrong. The really good thing about options is that you can go long while still protecting your short side, or you can go short while still protecting your long side. So you don't really have a binary decision of going up or down. Do both. Up, you make money. Down, you make money. If we stay sideways, squish, you get hurt, right? Do 2 out of 3. Up and sideways, down and sideways, up and down, but not sideways. Pretty much choose whatever you want. We are back inside the box. There is every expectation that we make it back down to the bottom of the box. And that would not even spook investors at this point. Um, we would just be cycling back through the same area that we've already been through. So we're not going to see much response from the VIX as we maintain these levels between 4,100 and 4,600. It's a really wide range. But as long as we stay within that box, you're not going to see a lot from the VIX. Right, for today, we'll just come out to the daily chart, mark the close from Thursday. So that's going to be our upside target. We need to get above the close from Thursday, which interestingly enough, was the same open as Wednesday. Institutional pivot points laying on top of each other. You got a very, very clear megaphone pattern here. And or you could look at this as a rising wedge. Generally speaking, we break out of rising wedges to the downside more often than we do the upside. But you do have to think about where that rising wedge fits into the context of the chart. Where's the primary trend, the secondary trend, intermediate trend? If those are unfamiliar concepts, really take a look at any books that cover Dow theory and add Wyckoff to that. I mean, those two are like must reads if you're getting into understanding the market. So if we look at the close from Thursday as a pivotal line in the sand, getting back above that would move us towards the highs of Thursday, and that is very likely going to be our day. Right? We have three scenarios of what a market could do. We could just stay right here in the middle. We could run all the way up, break out above Thursday's level and move to the upside, or we could break down below Friday's levels and move to the downside. That's the three scenarios. Well, you really got to ask yourself at this point, how likely is it that we're going to run up and break outside of yesterday's range? It's very unlikely. So while we can analyze it and talk about it, we wouldn't want to spend a lot of time on it because it's really unlikely. Even if we were to make such a move like that, it would be with so much breadth of the overall marketplace that it would not be subtle, right? It wouldn't be a slow grind. We don't even have time for it to be a slow grind because we've already burned 12 hours of the day, right? We don't have a lot of day left. So it would be a hard, sharp, fast, immediate rip to the upside with all the sectors and the market breadth and everything else coming in behind that. It would be directly connected to some sort of news and it would just be like shock and awe. So if it's not that, we can pretty much just take that one off the table. And that leaves us with the range that I've got drawn and or breaking to the downside below that range, which is a much more likely scenario at this point. One, because, well, we're close to that low. Two, the low was set basically in Globex. So the fact that we're inside day breakout already as we come into the open is very likely that we're going to stay broken out of yesterday's level. In fact, you would almost be better off marking the lowest point of our Globex and the highest point of our Globex and considering that the range with a topside breakout that could challenge yesterday's levels and a downside breakout that would put us back into the move towards the smaller time zones that we had just looked at out here, right? 43, 42.5. I think you'd find that to be a more beneficial way to approach the range. As you can see, we are outside of the box. This is the 10-day, 30-minute volume profile, value area high and low, point of control. We're outside of the value area low, but we are moving towards the volume profile, right? When we're out here, we want to ask that question, are we moving farther away from the profile or are we moving towards the profile? And you can see that we're moving back towards it, or at least attempting to. Keep in mind, linear regression and mean reversion alone suggests that the market would attempt this move to the upside. Whether it fails or not is a completely different discussion. But look at the way the market sweeps, right? Swing high, swing low, swing high, swing low. That's the way that works. So when we make a very aggressive, very big sweep, it is very likely going to move up before the next sweep. But look how you've got lower highs, lower lows, lower highs, and lower lows. And you still have that right now. There is no signal here at all that this is going to go to the upside. We do not yet have uh, a higher high, and we do not yet have an equal low or a higher low. So until we get either one of those, then we have absolutely no signal that this is turning and going up. None. Mapping out a 5 by 5 using the volume profile, you can see that there is a point of control at 44.20. That is Thursday's point of control. Should we get to that point, there is very likely going to be a reaction in the market. Should we get near that point, it's very likely going to become a gravity point. It will just draw price to it. High volume nodes generally uh, attract price, right? So if we get near it, we're very likely going to tag it. There is another one way up at 4,500. We're not going there today, right? So it just, you always want to carry those forward. So that covers the ES. For the Nasdaq, kind of want to start the same way that we did the ES. Take it out to the higher time frame. You can see that we're below that anchored VWAP. Just an easy visual cue. Draw the box and just take it with you and move it back a couple of spots and just ask that very simple, very basic question. Is the volatility getting bigger or smaller? And you can see that, I mean, for the most part, it's just like the ES. We're not seeing much of anything, right? No significant change in volume at all or in volatility at all. How can that be when we've had a significant sell off, right? A 10% move to the downside in the last 3 weeks, and volatility hasn't changed at all within this market. So, again, just like I was pointing out before, this is a huge heads up. This is a critical warning that the the volatility is not reflecting the risks and the dangers out there right now. It is worth noting since January or mid January, the box that we've been in, and the fact that we are past the 50% mark, right? If we were to use something like the quadrant tool, we are pulled back more than 50%. We are at a structural level, 13,800. Although we have come outside of this twice. We did get right back inside of it again. If you look at the Nasdaq from the volume profile, we are outside the box, but working our way back up into the box. Again, linear regression alone suggests that we would begin that move to the upside. Whether or not it sticks is a completely different discussion. And there is some volume resistance at the roundy, 14,000. There is a point of control at 14,030. It basically lines up with the NASDAQ channel of 3342, right? There's a channel at 14,033 to 14,042, and at 4132, 14,232, right? There's just a channel that exists there. A slight megaphone pattern, a little harder to see, but it is still there. Also a slight rising wedge. And again, generally speaking, when we have a rising wedge, we generally break out of the bottom of a rising wedge. But you have to keep in mind where that rising wedge came from. For the trading day, we got 3 scenarios. We stay in the range, break to the upside, break to the downside. If we use the more muted range like we were discussing on the ES, that would basically be the current Globex high pivot. You could even take it up a little higher, 13,900. That'd be all of the Globex high and the Globex low. And we could consider that our range. We are inside day breakout, meaning we've already left yesterday's trading range. If we're looking at a topside breakout from the Globex, that would only put us back inside of Thursday's price action. The targets through that price action would be the midday pivot around 13,975 ish, with that tweezer bottom midday. 14,085, and then start using the Globex from Thursday, 14.2, and the open from Thursday, 14,225. Really don't see we're going to make those kind of levels without news, right? So again, just like with the S&P, if we were to make gains like that, it would be directly connected to some news. It would not be a subtle move in the market. It would be swift and significant, and everything would be lit up. Positive sectors, positive move in the fangs, advanced decline line would be positive. Everything would be lit up. So it won't be a slow grind to be able to achieve those levels with the amount of time we have left in the day. On the other hand, we could stay inside the range as drawn. And then the third scenario would be that we break to the downside. We currently have an ADR of 2.5%. We're only down 0.5%. If we add 2% to that, it gets us around 13.5, maybe 13.5 half, right around in there. Again, that's an unlikely scenario. We've already had 12 hours of our day. There's not a lot of day left. We could make the move, right? We could. I'm not taking it off the table. I am just pointing out that it would be just as swift and just as significant as that upward move that we were talking about. Because if we were to make that 2.5% ADR at this point, it would have to happen quickly. All right, it's worth noting what's been going on in the other markets. Remember, the none of the market moves by itself. It is all directly connected to other things that are moving in the market. Bitcoin had a significant liquidation break last night. A couple of really good intraday moves on Thursday. Gold is bidding back up again. The bonds seem to have found a low, or at least are pulling back again. Keep in mind linear regression and mean reversion. The bond markets have just been absolutely ripped apart. Not quite sure what to say going forward. There's the expectation that they're going to normalize and stabilize. It doesn't appear to be anytime soon. That move in the dollar Thursday was just absolutely phenomenal. And notice when I line up the mouse across these charts, this move to the downside in the bonds corresponds and correlates with the move to the downside in the S&P and the Nasdaq. These are not inverse markets like a teeter-totter. When one goes up, the other one does not have to go down and vice versa. Generally speaking, that's what they do, but there's no guarantee that says that's what has to happen. So when that's not happening and that's the norm, we use the phrase, like when what should happen doesn't, you really want to pay attention and back away and approach with caution, right? It's not supposed to do this. So as long as it continues to do that, you want to be very mindful and very cautious as you approach it. Uh, Look for them to decouple before getting into a trade, or just run your stops maybe a little different, change your position size, and recognize that until it decouples, until it quits doing the same thing, that you're just in a market that is behaving so erratic and so odd that we're seeing things do what it's not supposed to do. And we are looking for that decouple, right? We're looking for stocks to go up and bonds to go down, or for bonds to go up and stocks to go down. But at the moment, stocks and bonds went down last week. And now here in the Globex, stocks and bonds are going up. Cats and dogs are drinking coffee and hanging out together. Oil gave back a little bit of that move from Thursday, but not a lot of it, right? It's maintained a significant amount of that move. And there was a little bit up in the VIX going into the close in that last hour or so. But look at the VIX overall, taking that thing out onto a daily chart, and really just with the whole smorgasbord of lists of things that are causing angst in the market. Where's the VIX? Right? Like where's this thing? And ask, does that really reflect the current level of fear and uncertainty and these real big moves that we've seen in the market? And the answer is no. No, the VIX isn't responding at all. There was a couple of articles that are talked, uh, JP Morgan, Wells Fargo, that have pointed out that the hedge trade, the trade that the institutions generally use as a way to kind of protect their assets, they took it off and they haven't replaced it. So a lot of them are running without it. Likely from the idea that we've already made, significant moves to the downside, and we set some strong structural lows, and that those lows are likely to hold. And it also kind of leans into the idea of what I said at the beginning, that when everybody out there is pointing to the downside and saying we're probably going to go down from here, it's usually a good time to buy. All of the contrarian indicators are pointing that we're in a buy. Of course, they've been pointing that we're in a buy for a while, and you can see that that didn't play out too good. Cyclicality suggests that we begin a significant move to the upside uh, around the first week of June. So, stick that in your pocket. All right, so we're looking at the sectors here this morning. You can see that we are in a risk off market sentiment. It's a very muted market this morning, just not a whole lot going on. The banks kicked off earnings last week. That's going to continue into this week. We also got some big names beyond the banks, some big tech names reporting this week. Some of your more defensive cyclical names are continuing to do really good. When we're looking at more of the S&P sectors like XLF, XLK, both of those are down negligibly, not even a half of a percent yet. Don't like to really count them until we get below a half of a percent, but emerging markets are down a half of a percent. Healthcare, consumer discretionary, Bitcoin, marijuana, all down more than a half of a percent. But things like small caps, technology, semiconductors, they're only slightly down, kind of just a little squishy, but not really negative. And the XLF is basically flat. You start looking at what's positive: utilities, industrials, building materials. That's literally the midline, um, the three sectors that we watch when we're talking about names that can do good in a good economy or a bad economy, not a good day or a bad day, but an overall economic perspective. XLI, XLB, all doing good this morning. Energy's making that move back up again, that just beautiful, consistent, persistent move that we've been getting since December of last year. Notice the KBE. This is a financial ETF. It's just different. It's more nuanced and more focused. When you say finance, it's a broad brush that has things like insurance, trading, lending, credit cards. Finance is a really big, really vague description. If you want to get more nuanced with it, you want to look at ETFs that represent different parts of that financial, regional banks, credit cards, right? Actually breaking it down one step farther. And that's what KBE offers. You can see we're up 0.75% this morning. Silver, gold, natural gas, right? All part of that cyclical. So one of the things you're going to want to look for this morning to kind of confirm if we're going to see that rally in the S&P and the Nasdaq, you're going to want to see a real shift in sentiment within these sectors. It's not necessarily just what the numbers are saying, right? It's the names that are in these sectors through the morning. We want to give a good 2 hours to the market to balance the news. I'm not saying stand aside and not trade. I'm talking about getting a broader context of where the market's going for the week. it's likely to take a good 2 hours, 2.5 hours before we start to get that weekly bias. Certainly, we can trade, even first thing in the morning. There's absolutely nothing that says we shouldn't trade. We're just talking about letting this market absorb the news from the weekend and then making a more informed decision about what's likely to happen for the rest of the week. With that, you want to see the names that are in these sectors and what are they doing. I tend to break them down into things with their own chart groups. So, for an example, here we're looking at the FANG names, right? It's a daily chart of the FANGs. Right now, since Thinkorswim does not recognize pre-market moves on the daily chart before 9:30 in the morning, this is not reflecting any movement from the pre-market. So it's only giving us the close from last Thursday. But if we were going to see a rotation this morning and start to climb up out of this hole that we're in, we would need the FANGs, and we would need finance and or the technology ETF names to get off of the bench and get into the game. Healthcare is another one. Healthcare actually makes up a significant portion of the S&P, right? And so even though it's not one of our risk on sectors, it absolutely is a sector that can weigh down the marketplace. It can't beat the FANGs, right? Nothing beats the FANGs. But if these go sideways and are not influencing our market, then absolutely healthcare matters. But even with the news that was coming out on Tesla, you can see there really hasn't been a significant change in pricing. We kind of bid up and kind of bid down and just, shook the dog and didn't get anywhere. So is starting to present what I like to call a failed flag play. If you consider it from what a flag is supposed to do, a flag is supposed to be a continuation of trend, right? A trend is nothing more than a bunch of micro flags, just each one leading into the next one and into the next one and into the next one. So when you have a significant, consistent, persistent market direction like Tesla, and then it bases and sets those lows and does not continue to the downside, then that flag is starting to present failure. If we continued going lower, then it wouldn't be a failure, right? Because that's what we're supposed to do. We're supposed to go lower. Flags are continuation patterns. So if we break out of the top of this channel, then it invalidates the flag. We would say the flag is dead. It's no longer viable. There is no more flag. And instead, we would begin building a cup and handle, right? We would have the left side of the cup, the base of the cup. We would look for micro trends to build us back up to the top of the cup. And we would then have a very large cup. To get that cup and or cup and handle, you would still need a top side breakout of this base. Should we happen to break to the downside, well, 960 is the downside target. As you can see, we are inside the box. There is a significant level of volume there because we're at the point of control. It is really important to recognize where the point of control is all the time. When you look at a volume profile, look at where that point of control is. Now, with the lines that I had drawn, it kind of obscures the point of control. So I'll get rid of the lines. It's the red line here at 991. That's where the point of control is, and that's the value area low. So you can see that they're very close together. In a clean distribution, it would be more in the middle. Also, there's a significant level of volume to the upside around 1,000 and around 1040. If we break the low from last week, there's nothing really to catch us until 920. So we have the low of Wednesday, we have the low of Monday, Tuesday. Below that, we're headed to 920. That's what I got for you guys. Be careful, be safe. I will be streaming in the futures. I'll see you all there.